Hey Smarter Vets, CJ Burnett here, reflecting on this year, and because it's December 2025, thinking through a few of the cases and maybe some of the surprises, like the things that clients were most surprised about whenever we reviewed their plan. One of the biggest ones that I have found was a lot of people who came to us had more than $1 million outside of a retirement account, right? A liquid investment account, managed wealth account, mutual funds, whatever it was. And I was just so surprised to see all these people with over $1 million in an account without tax overlay services. They were being managed either by the client or by another advisor where taxes weren't taken into consideration at all. And you had a lot of trading. You had a lot of things that were overturning and a lot of things being bought, a lot of things being sold, not a whole lot of strategy when it came to the tax side. And the biggest surprise that these clients had was whenever I looked at these portfolios and I saw what, again, they're over $1 million inside of non-retirement accounts. So they're taxable every year. Just the amount of, I would say almost the lack thereof of diversification. And what I mean by that is they had multiple holdings inside the account, but a lot of these accounts, and I say a lot, like there was a good amount this year that whenever I reviewed, a lot of these accounts just had a lot of mutual funds in them. And a lot of those mutual funds actually had the same investments inside of those mutual funds. So the client thought they were diversifying, but they're just diversifying the diversification and then ending up in the same spot. So just a little bit of a warning for those of you out there with a lot of money in a taxable liquid investment account. If you're managing it for yourself or if you have a professional managing it for you, just take a little extra close look at how you're structuring the investments to ensure that you're not paying a lot of money in taxes, because you might eke out another 1 or 2% on the growth of the returns. But if you're paying a higher tax on the income that's being earned on the portfolio than you otherwise would have or would need to, like if there's a way to avoid it, and there's usually a lot of different tips and tricks that people can do in order to avoid extra taxes on those portfolios. Please maybe get a second opinion, maybe get somebody else's eyes on it. Because if you have over $1 million invested in mutual funds without a really good reason as to why, I'm not really sure why else you would want to do it. Like I just can't come up with a good reason in my head as to why you'd have over $1 million in an account generating a bunch of taxes and then not really providing a lot more growth on the other side of it. So, and to give an idea, remember long-term capital gains taxed at a lower rate than ordinary income. So short-term capital gains taxed at ordinary income. Maybe if you're in income brackets, like you're in the top 10% or even the top 1% of America, there are a lot of things that you could be doing in order to structure your investment portfolio to focus more on growth and not pay so much in taxes. This is CJ Burnett. Hope to see you next time.